Okay, hi everyone. This is going to be the first lecture here for chapter 24. We're looking at international taxation. So this was the area I worked in at Deloitte. It's a growing hot area in the sense that tax reform, they made a flat 21% corporate tax rate. So not a lot of planning you can do with that from just like a rate perspective. It is what it is. But they created a lot of international provision. So that's where kind of the savings, the planning, the consulting, the compliance has moved. So international tax is like pretty much like the second most important team, secondary to like the C Corp team. And as a starting point, right, we need to, when we're talking about international tax, distinguish outbound taxation from inbound taxation. The point of view here, the reference is the US. Right? Outbound taxation is how the US is going to tax a US taxpayer on their foreign income, right? So say we have Apple, right? They're a US company and they go to France, right? They open up a company over there, a branch or a subsidiary. How does the US tax that? On the flip side, right, inbound taxation is how the US taxes US source income from non-US taxpayers, right? So here, maybe we have an Italian coffee company, right? They come and open a store in the USA, right? How does the US tax, this coffee company's earnings in the US? Right? So outbound taxation, right? We got Apple who is doing business in France, just as an example, right? How does the US tax those earnings? Inbound taxation, right? We got the Italian coffee company who's coming into inbound to the US, selling coffee. How does the US tax those US earnings? Okay. With regard to inbound taxation, right, that Italian coffee company, right, the US is going to tax any of the income earned in the USA. However, right, to the extent we have foreign source income, right, so say they have income in Italy just from selling their coffee there, right, that's going to be taxed by Italy. In other words, the US isn't going to touch their stuff over in Italy there. With regard to outbound taxation, right, we have Apple going to France, right? They're a US taxpayer. With regard to their US source income, right, selling iPhones here in the US, right, obviously the USA is going to tax that. With regard to their foreign source income, right, stuff they sell in France, that's going to be taxed by the USA plus by France, right? And to the extent France taxes that income, we're going to potentially be eligible for a foreign tax credit on the US return to help mitigate double taxation, right? Because we made $1 million over there. France taxes it. US is going to tax it. That same income was taxed twice. As a general policy, we don't like that in tax. So, like the state and local tax kind of chapter and arena, if you want to be a country and tax somebody, you have to have nexus, right? You have to have basically some type of reasonable contact, or there needs to be a basis upon which you tax a person that warrants jurisdiction in that case, right? If you made money here from working a job in the USA and Germany came up and said, hey, we want to tax that, you'd say, this is crazy. I have nothing to do with Germany, right? You can't tax me. That's not fair. So there needs to be some type of basis or nexus in this case. And how countries call into or warrant taxation, right? They can base this nexus on residence-based jurisdiction. Hey, Apple, you are a U.S. resident. We therefore reserve the right to tax you on your earnings, right? We can base it on your residence or source-based jurisdiction. Where is the source of this income. Hey, Italian coffee company, you are selling stuff here in the USA. The source of that income is here in the USA. We reserve the right to tax you on it. We talked about the foreign tax credit. Another way that they can mitigate double taxation is through tax treaties. We'll talk about those later in the chapter. In this framework with inbound and outbound taxation, right, non-residents, right, are only going to be taxed on their FDAP income, fixed, determinable, annual, or periodic, tends to be passive income, or their effectively connected income, tends to be more active income. We'll talk about this. With regard to outbound taxation, general rule is going to be worldwide taxation, right? We get you on everything in the world. We do have some specific rules, however, for corporations, right? With regard to corporations, the general rule is we aren't going to tax any foreign income until it's repatriated or brought back to the USA. And we have something called a participation exemption that says, hey, when you do bring that back, we're going to give you a 100% dividends received deduction for this, which effectively makes it tax-free. We want to encourage you to bring things back. However, we have some exceptions, right? And again, we'll talk about this. I'm just laying the framework here. To the extent you have something called Subpart F income or GILTI income, we will not let you defer it until repatriation. Instead, we're going to make that immediately taxable right now. Okay, so this is like laying the roadmap for where we're going. Let's start with inbound taxation, right? So non-residents, right? We got that Italian coffee company. The U.S. only taxes them on their U.S. source income, what they're doing here in the USA, or what their connection to it is. We can have FDAP income or ECI income. Tends to be more passive and active. Let's start with ECI, right? This is effectively connected income. It deals with a U.S. trade or business, right? So for example, a German corporation opens a U.S. manufacturing plant. An Italian coffee company comes and starts selling coffee here in the U.S., right? This is really a business they're doing here in the U.S. They're going to be, if they're acting as a corporation, right, they're going to be subject to tax on their net income at a 21% rate. In distinction, right, FDAP income tends to be more passive, right? This would be like, hey, I am a Japanese corporation, but I get some dividends from owning Apple stock in the US, right, here. So it tends to be more passive in that way. What will happen is, right, in this case, they're going to be subject to, right, that's U.S. source income from because it's connected to the U.S. They're going to be subject to a 30% tax on their gross FDAP income, right? So FDAP income tends to be more passive, whereas ECI tends to be more active. We're in the inbound arena here. It's going to be 30% on the gross. Here it's going to be 21% on the net. Let's look at an example here, right, with FDAP income. So let's say we have a foreign corporation with $100,000 of FDAP dividend income, right? So we're over here, we're a foreign corporation. They must make some type of investment in a U.S. corporation that says, hey, we want to pay you a dividend, right? You non-U.S. resident. We want to pay you $100. But here's the deal, right? Because this is FDAP income, right off the bat, right, us, Y, U.S. corporation, we're going to have to withhold $30 and we'll send you $70, right? We withhold this because it's like the same they withhold for your paycheck, your W-2. If we didn't do this, you could just kind of run away and good luck for us collecting it. on there. So that's the deal with the FDAP income, right? X over there, the foreign corporation, they're not going to have to file a U.S. return for this. A lot of times tax treaties lower this withholding rate. So like I have seen like 15% before in practice. How about ECI, right? This is more active, right? Let's say we have a foreign corporation, that Italian coffee company, they come to the US, right? They do 250 in sales and have 50 of expenses, right? Their net, when you net those, is going to be 200,000. They're going to owe 42,000 on that, right? They're going to file a form 1120F. If it was a non-resident alien individual, they would file a form 1040NR. Right, so we talked a little bit about the framework there with inbound taxation. One of the things here with it is you have to see, where are they a resident of. When we talk about non-U.S. citizens, right, they're either residents or non-residents. A resident is basically someone who has a green card, or they're physically present in the United States for 183 days. There's some kind of nuances with that 183-day test, but that's the starting point there with individuals. If you're not a U.S. citizen, well, then you're either a resident or a non-resident. Corporations, we determine residence based on where you're incorporated, right? So, hey, Apple, you're incorporated here in the U.S., you're a U.S. resident. Hey, Italian coffee company, you're incorporated in Italy, you are an Italian. That's your residence, how we look at it. And we said, right, a couple things here. One of the things we talked about is we have a foreign tax credit, right? This can help alleviate double taxation. A few things to be aware of with this. First off, the foreign tax credit is up to the amount of tax you would have paid in the US, right? In other words, say you made $1 million and you paid 12% tax in France. Had you made that $1 million in the USA, you would have paid 10%. Accordingly, we're only going to give you a credit for 10%, right? That remaining 2, right, you don't get it right off the bat. That's going to be an excess foreign tax credit. You can bank it for later on, use it, right, following these kind of carry back, then carry forward 10-year rule, but we don't, let you get that right off the bat there. Likewise, when we talk about the foreign tax credit, we're going to do, one foreign tax credit for each basket of income. So it's not just like one single calculation, right? You have to kind of sort your income once you have it into the different types of baskets. And then within each basket, you calculate a foreign tax credit. So the formula for it, right, the foreign tax credit limitation, you're going to take basically your foreign source income over your worldwide or total income, and you will multiply that times your U.S. tax liability before the foreign tax credit, right? This is going to give you your maximum foreign tax credit allowed, right? So say we calculated that and this was $1,000. Right? If you had paid $700 in foreign taxes, right, then you would get a credit for all $700. That's great, right? It's below the max, right? So say you made money in France, right, and you paid $700 in tax, we'll reimburse you more or less for all $700. But if you had made money over there and you had paid $1,200, right, well then you're going to be capped at 1,000, right? That's kind of the maximum there. That additional 200, right? That's going to be an excess foreign tax credit that you can't use, until you later on have more income. You deal with that on another year's tax return. Continuing here, right? When we talk about income, right? In order to effectuate and apply certain tax laws, right? We need to know how to source income and deductions, right? We have rules that tell us, do we put this into basically U.S. source, or is this foreign source, right? It can be income, it can be deductions, right? But essentially the first thing we got to do is look at all the income of the business and kind of put it into two buckets, US source bucket and foreign source bucket. We said here, right, non-US persons, why do they care about this? If you're a person, or a business in Italy, for example, why do you care about the sourcing rules? Because generally, right, whenever we look at your income and we put it in the buckets, right, we're only going to be able to tax the US source, right, from your sort of Italian coffee company sales here in the US, right, your ECI or your FDAP income. US persons, right, when we're talking about individuals, it gets tricky with corporations when you do this, but let's just say US persons, they're going to be subject to tax on their worldwide income, right? So it's going to be their foreign source income and their US source income, right? Like the blue and the green there. They care about this, right, the sourcing rules, because among other things, it's going to help them determine their foreign tax credit. We're going to use these sourcing rules if you're an individual for something called the foreign earned income exclusion. Okay? So when we talk about the sourcing rules, there's rules for income and there's rules for deductions, right? The source of income rules, right, tells us whether income is going to be US source or foreign source. And generally, right, the rule here is going to be based on residence or location of the income. One easy way to think about this is, hey, we're going to list out all the different types of income, right, like active income, dividends, wages, rental, and each type of income is going to have its own rule that helps tell us, do we put this in US source income or do we put this in foreign source income? Okay, so let's look at the different types of income and look at the rules, right? With regard to interest income, right, the rule is going to be look to the residence of the party paying the interest, right? Wherever the residence of that party paying the interest is going to be, the sourcing rule, right? So say we have a French bank, right? And they pay us as a US individual interest income. Well, we look to the payer, right? The bank, they're in France, we're going to put that in foreign source income. If we flip the scenario, right, it's a US bank that pays the interest, right? It's going to be US source income. So you need to look to the residence of the person paying the interest. Same rule for dividend income. Essentially, look to the underlying corporation that's paying the dividend. Are they in the US, right? Are they a US corporation? Well, then it's going to be US source income. If not, right, it's going to be foreign source income. How about services, right? Well, we need to look at the location where the services are performed, right? If we are, painting houses, right? If we paint a house here in the USA, that's US source income. If we travel north, we go to Canada, right? We're painting houses up there, right? It's going to be Canadian source income, foreign source income in Canada, right? We look to the location physically, where are we doing and performing these services? One thing to be aware of here is there's something called the commercial traveler exception, and it basically says this, right? If you are a non-resident alien, right? Say we got a guy from Germany or something who's just coming here for a short-term work visit. If you're here for 90 days or less, and you get less than $3,000 of service income, and the services are performed for a non-resident alien, a foreign corporation, or a foreign partnership not engaged in a U.S. trade or business, or a foreign officer or individual who is a citizen or resident of the U.S., domestic partnership or domestic corporation, we're not going to treat it as U.S. source, even though you physically worked and you performed the services here. Okay? 20, right? Rental income. We need to look at the location of that rental property. If it's in the United States, right, that's U.S. source income. If it's over in China, right, that would be foreign source income. So look to the location of that property. Same with royalty income. Likewise, sale of manufactured inventory. So we make this inventory, we look to the location of the assets used to produce that inventory. So, hey, we sell widgets, right? Where is our factory that we make these widgets? Is it in the United States? Then the income from the sale of this inventory is going to be U.S. source. If our, if we make widgets and we, make them like in China, right? Then that's going to be foreign source income from the sale of that manufactured inventory. Likewise, gain or loss on the sale of personal property is sourced to the residence of the seller, right? So personal property, hey, maybe there's a truck, a car, whatever, right? You sell that, right? We look to the residence of the seller. Are you a U.S. resident or are you a resident from somebody else, another country on there? So let's look at an example here. Right, we have America Corporation. They are a U.S. corporation and they have the following income, right? So they have $75,000 of income from services that they performed in Canada, $100,000 of business income from U.S. operations, so just kind of general operating income, $30,000 of interest income from a Mexican bond, $25,000 of rental income where the property is located in Germany, and then $20,000 of dividend income from Big Corporation, a U.S. corporation. Right, in total here, we have $250,000 of total income. We need to figure out how much of this is foreign source income versus U.S. source income, right? We need to apply those rules. So let's start here with the U.S. source income, right? Well, obviously, right, it's going to be our business income, right? We were performing services in the U.S., right? There we go. Likewise, it's going to be that dividend income, right? Because the underlying corporation that's paying the dividend is a U.S. corporation, right? So our U.S. source income is going to be 100 plus 20, right? We were looking at 120 here. We then know, right, that this is going to be 130, right, just because it's got to equal 250. But let's look at it to see the rules here on it, right? The foreign source income. Well, from the services, right? The services, we look at where did you perform the services, right? Well, you did it in Canada. So the location, that's foreign source income. Likewise, interest income, we look to basically the person who's paying the interest, right? Well, that's Mexico, right? There in Mexico, that's going to be foreign source income. Likewise, rental income, right? We look to the location of the property, right? That's in Germany, right? So that's going to be foreign source income on that, okay? Likewise, once we find out our U.S. source and foreign source income, right, using these sourcing rules, then we have additional rules for deductions, right? Source of deduction rules. And this basically says, hey, we're going to help you allocate and then apportion allowable deductions associated with this income. And again, why do we care about this? Well, a U.S. taxpayer is going to use this when they're calculating the foreign tax credit. A non-U.S. taxpayer, right, they're going to use this to help offset that ECI, right, to get the deductions on there. So we talked about the income, that's great, but what about my deductions? Right, so what are the rules here, right? Well, overall, right, the U.S. is trying to match the deductions with the income, right? They're going to try to follow that matching rule. And essentially, right, first thing we're going to do is allocate or associate deductions with kind of classes of income, right? What were your different types of income, A, B, C, D? If we were to kind of like match the deductions with this, how would we line it up? Right, thereafter, right, once we kind of allocate, then we need to apportion the deductions or separate it between US and foreign source income, right? So let's look at an example here, right? It says at the end of the current year, America Corporation identified and classified $1 million of income, right? That's great. So we have $1 million of income, right? 800 is US source income and 200 is foreign source income, right? That's great. We just looked at the income. We said, hey, when we made this income, right, part of the deal with it, how we had these sales, we had an associated expense, right? In other words, we did some advertising. $10,000 of advertising and expense helped us generate this income. So that's kind of the first thing we want to do here is like match or associate the income with the particular deduction. Now the question is, right, well, we have 10 grand. How much of that do we kind of mete out to US source income versus how much of that do we give to foreign source income? So here, right, when we apportion it, right, we're going to do essentially just the expense, and then we're going to do pro rata, right? So if we're trying to see for US, right, it's going to be the 800 over a million total, 8,000, right? So if 8,000 is there, right, 2,000 of that deduction we're going to apportion to foreign source income. A few things here, right? There are special deduction rules, sourcing rules for particular types of deductions. So interest expense, right? We're going to apportion that based on the average tax book value of the assets. Research and experimentation, right? This has to be apportioned using the sales method where half of the expenditures is going to be based on where the research is conducted, and the other half is based on US and foreign sales to total sales. And then finally here, US state and local income taxes, those are going to be allocated to the state imposing the tax. So let's go through, right, this is about halfway through the deck here. Let me see, where did we end up here from like the Excel problems, 24-6. So let's go through and look at some of these like Excel problems in the book, just to rehash this. So we have a U.S. Corporation. They open a store in Canada. CA as an unincorporated business. Will they be subject to Canadian earnings? Yeah, there's nexus there with Canada. You're doing stuff there. You're going to be subject to Canadian tax. Right? Whatever how they tax it, right? Whatever their rules are, you're going to be subject to. There could be a treaty, right? One of the things here is like when we talk about, for example, inbound and outbound, we're focusing on the U.S., but you could apply inbound taxation for Canada, right? So in this situation, from Canada's point of view, us and the U.S. going there, that would be inbound to them, right? So it's kind of like we're talking about it from the U.S., but that concept of inbound is a more general concept. Here they talk a little bit about right, that 183-day test for like resident versus non-resident. You can look at that. I'm not really concerned with that. Here's the foreign tax credit, right? So essentially, we run the calculation here on it, right? Foreign source income to total times U.S. tax liability, 8,400. That's the max. Hey, if we paid 7,200 overseas, right, to like France, then we could get all 7,200 as a foreign tax credit, right? That's below the max. If, however, right, we paid 10,000 overseas, we're going to be capped at the max, right? The additional foreign tax credit there, that's going to be something we carry back then forward, okay? Here it says a U.S. corporation invests in a Canadian government bond and they receive an interest payment as this U.S. or foreign source income. Well, hey, it's foreign source income. We look to the residence of the payor, right? The payor here is Canada. Therefore, it's foreign source. It's not in the U.S. Hey, we have a U.S. corporation that invests in a Canadian company stock that pays a dividend, right? Well, we look to the essentially the residence of the payor. Well, the payor here is a Canadian corporation. Their residence is Canada. It's foreign source income. Here it says, we have a branch employee who works in the U.S. and receives $5,000. How much U.S. source income do they have? Right, well, it's going to be $5,000. They were coming here, they were performing, sorry, my alarm's going off there. They were performing the services here in the U.S., right? It looks like they made too much money to get that commercial traveler exception. We're here for like the short period of time, and then they modify it a little bit with some additional facts. Okay, so with that, I'm going to end lecture 1 here. We'll pick it up in lecture 2.